How does the Federal Reserve's monetary policy shape the volatile world of Bitcoin and altcoins? From soaring inflation to dramatic interest rate hikes, the Fed's moves ripple through the crypto market, influencing prices, investments, and adoption. Join us as we unravel this high-stakes battle between centralized control and decentralized innovation. Let's dive in. The Federal Reserve and cryptocurrencies are two forces at opposite ends of the financial spectrum. One represents centralized monetary control, and the other represents a decentralized rebellion. But how do Fed policies, particularly on inflation and interest rates, affect Bitcoin and altcoins? Today, we're diving deep into the Fed versus crypto to unpack the complex relationship between US monetary policy and the world of digital assets. Let's get started. Let's begin with inflation, a critical factor in understanding Bitcoin's positioning as digital gold. Inflation erodes the value of traditional currencies over time. In response, many investors turn to assets like gold, which are scarce and maintain value. Enter Bitcoin, often likened to gold because of its capped supply of 21 million copies. Think of Bitcoin as a digital version of gold bars. Unlike the US dollar, which the Federal Reserve can print at will, Bitcoin scarcity is built into its code. This has led to some investors to view Bitcoin as a hedge against inflation. During periods of high inflation, like in 2021, Bitcoin prices surged as people sought alternatives to cash. Example, between 2020 and 2021, as the Fed injected trillions into the economy through stimulus measures, Bitcoin's price skyrocketed from around $10,000 to $60,000. The narrative? Bitcoin thrives when inflation fears grow. Do you think Bitcoin can truly replace gold as the go-to inflation hedge, or is its volatility too much of a hurdle? Now let's talk about interest rates, the Fed's primary weapon against inflation. When inflation rises, the Fed often responds by hiking interest rates. This makes borrowing more expensive and encourages saving over spending. But what does this mean for cryptocurrencies? Higher interest rates tend to hurt speculative investments like Bitcoin and altcoins. Why? As returns on traditional assets like bonds become more attractive, investors pull money out of riskier assets. For example, during the Fed's aggressive rate hikes in 2022, Bitcoin's price dropped from over $40,000 to under $20,000. Imagine you're an investor. If a US Treasury bond offers a safe 4% annual return, why risk your money in volatile assets like crypto? This shift in sentiment often leads to significant sell-offs in the crypto market. Did you notice the crypto market's reaction to the Fed's rate hikes last year? How did it affect your investment strategy? The Federal Reserve uses interest rate hikes to combat inflation by making borrowing more expensive. This slows down the economy by reducing spending and investment. Last year, when the Fed aggressively raised rates, the impact on the crypto market was significant because it's closely tied to investor sentiment and liquidity. Let's break this down step by step. How did Fed rate hikes impacted the crypto market last year? First of all, less cheap money for risky investments. When interest rates are low, borrowing money is cheap. Investors often pour that cheap money into risky assets like cryptocurrencies, hoping for higher returns. Imagine you have access to a loan with 1% interest. You might take that loan and invest in Bitcoin, which has historically shown potential for much higher returns like 10 to 20%. The low cost of borrowing makes the risk worthwhile. When the Fed raised rates, borrowing costs increased. With loans now costing 4 to 5% interest, investing in high-risk assets like crypto became less appealing because the potential return might not justify the high borrowing costs. This time, the trend is pulling out of risky assets. Crypto is considered a risk-on asset. Investors buy it when they feel confident and sell it when they're cautious. For example, during periods of economic uncertainty, investors move their money to safer assets like bonds, which became more attractive due to higher yields caused by rate hikes. Bitcoin and other cryptocurrencies saw significant sell-offs. In 2023, Bitcoin's price dropped during periods when the Fed announced aggressive rate hikes because investors were fleeing to safer investments. Rate hikes also mean decreased liquidity. Higher interest rates mean people and institutions have less money to spend and invest. Example, a crypto trader who used to rely on cheap loans to trade Bitcoin on margin that's borrowing money to buy more now faces higher costs and reduced leverage, which reduces trading activity and liquidity in the market. Low liquidity means bigger price swings. Cryptos became more volatile with sudden dips or spikes in reaction to Fed announcements. So how did the interest rate hike impact our investment strategy? First of all, adjusting risk exposure. With the Fed hiking rates, the crypto market entered a bearish phase. Investors like us needed to rethink how much risk we're willing to take. Also, there will be a strategy change, shifting focus to less volatile assets or reduced overall exposure to crypto. For example, instead of holding speculative altcoins, which are small cryptocurrencies, we might have concentrated on more stable assets like Bitcoin or Ethereum, which tend to recover faster after downturns. Next is timing investments. Fed rate hikes caused crypto prices to dip repeatedly, creating potential buying opportunities. Example, if Bitcoin dropped by 10 to 15% after a Fed announcement, some investors used these dips to buy crypto at a discount, betting on long-term recovery. This required careful timing and confidence in crypto's long-term prospects. The major lesson was diversifying beyond crypto. Relying solely on crypto during a high-rate environment became risky. Example, diversification meant investing in other areas such as high-yield bonds, stocks in sectors resilient to rate hikes like healthcare, or even keeping cash reserves. This approach minimized losses while keeping options open for crypto's eventual rebound. Another thing to focus is dollar cost averaging, or DCA. Instead of trying to time the market perfectly, many have shifted to DCA, which involves investing a fixed amount at regular intervals. For instance, buying $100 of Bitcoin every week regardless of its price. This smoothed out the impact of price volatility caused by rate hikes. What are the lessons learned from 2023 for the coming years? Be prepared for macro factors. Crypto doesn't exist in isolation. External events like Fed policies can drastically influence its price. Adapt quickly. When the Fed signaled aggressive rate hikes, shifting strategies early helped reduce losses. Having a long-term perspective. Even though cryptos dipped due to rate hikes, long-term holders who believed in the technology, like Bitcoin's limited supply, saw the downturn as a temporary phase. Whether you're a seasoned investor or new to the game, staying informed is your best tool for success. Thanks for joining us on our journey through the Fed versus crypto. Don't forget to like, comment, and subscribe for more insights into the ever-evolving financial market. Until next time, stay informed and stay ahead.